Welcome to the Deep Dive, where we cut through the noise to get you truly well-informed fast. Making smart investment decisions these days, it can feel less like analysis and more like trying to piece together a puzzle where half the pieces are missing, maybe, and the other half are upside down. Information overload is just so real and often obscures the full picture of what's genuinely happening with a company. And well, that's exactly why we're here. Today, we're peeling back the layers on a major airline company at a really critical point. Alaska Air Group, ticker ALK. We spent a lot of time with a detailed investment report on ALK, and our mission today is basically to unpack its pretty audacious strategic moves, dissect its current financial health, and dive headfirst into the fascinating, sometimes conflicting debate around its valuation. We really want to help you understand where the stock stands today and what critical factors you need to watch for.
Exactly. And that's really the core of this deep dive for you today. It's an exploration of those very conflicting ideas and, the hidden opportunities that often lie within these kinds of complex investment scenarios. What's really crucial here isn't just knowing the headlines. It's about understanding the specific nuances, the details that drive smart decision-making and seeing both the potential upside and the significant risks involved.
Okay, let's start with who Alaska Air Group actually is. It's a holding company, right?
Right.
Founded back in 1985.
Mm.
And they operate two core airline brands you probably know.
Mm-hmm.
Alaska Airlines, that's their main one, and Hawaiian Air, which is their regional carrier.
Mm-hmm.
Historically, they've had this incredibly strong concentration, mostly on the West Coast, U.S., Canada, Mexico.
Yeah, particularly the Pacific Northwest. They hold a dominant, 54.3% market share up there. They really do kind of own that region.
They really do. But then, late in 2023, they made this pivotal strategic move, huge news at the time, the acquisition of Hawaiian Airlines for about $1.9 billion.
Right.
Now, this wasn't just a simple expansion. It feels like a really bold bet. You could see it as both offensive and defensive, couldn't you?
Absolutely. Offensively, it immediately opens up these vast trans-Pacific routes, gives them that crucial hub in Honolulu, and really expands their leisure travel offerings, particularly looking towards Asia.
And defensively.
Well, defensively, it massively increases their scale. It helps solidify that West Coast position against rivals like, say, Delta Airlines, which has been pretty aggressive moving into ALK's home turf in Seattle.
Right.
And what's truly ambitious about this whole acquisition is the financial goal management has tied to it, their Alaska Accelerate plan.
Hmm.
They're aiming for a staggering $1 billion incremental pre-tax profit.
$1 billion.
Yeah, it's huge. So this isn't just about getting bigger. It's a monumental play for better profitability. But, that inherently carries considerable execution risk.
Like so.
This kind of target, while it sounds great to investors, means the stakes are incredibly high for actually integrating Hawaiian Airlines smoothly. It's not just about buying, it's about making it work, flawlessly combining everything.
And speaking of profitability and maybe things people overlook, there's this really interesting aspect of ALK's business model, their mileage plan revenue.
Ah, yes. The loyalty program.
Exactly. When I think airline revenue, my mind goes straight to ticket sales,
Yeah.
right? But this loyalty segment, it counts for a surprisingly stable, 5% to 7% of their total revenue?
That's right. And critically, it's high margin and remarkably stable, especially compared to the volatility of passenger ticket sales.
Which is huge in the airline business.
It is. In fact, the strength of this program is so significant that the company actually used it as collateral. They got $2 billion in financing to help retire debt from the Hawaiian acquisition, backed by the mileage plan.
Wow. That tells you just how pivotal this seemingly small revenue stream really is. It's not just a perk for flyers, it's a core financial asset. All right, let's widen our view a bit. Let's talk about the airline industry itself. It's a notoriously tough business, isn't it?
Oh, definitely. It's mature, highly capital intensive. I mean, think about the cost of planes, infrastructure.
Billions and billions.
Right. And you've got really high fixed costs, intense competition everywhere you look. And despite all that competition, the barriers to entry for new players are still significant because of the huge upfront costs and all the regulations.
So a tough playground.
And stepping back to the broader context, the industry's sensitivity is something you really need to grasp. It is highly cyclical. Meaning its fortunes are just intrinsically linked to the broader health of the economy. Air travel, both leisure and business, it's very much a discretionary expense for most people and companies.
So if the economy dips,
Demand for flights drops sharply. Plus, it has pronounced seasonality. Demand is typically strongest in the summer, Q3, and around the holidays in Q4, weakest in Q1, often leading to operating losses then.
And the pandemic recovery probably made that worse.
It made it even more distinct, yeah. Because the recovery was so heavily skewed towards leisure travel, it makes airlines even more reliant on those peak vacation periods.
Okay, so how has ALK been navigating these challenging skies financially? Their recent performance shows what the report calls a divergent financial recovery. What does that actually mean?
Well, it means their revenues have bounced back strongly. They've even exceeded pre-pandemic levels. Like in 2024, they hit $11.7 billion in total revenue.
Mhm.
Compare that to $8.8 billion back in 2019.
That sounds pretty good. A significant jump.
It is on the top line, but here's the catch. Their net income, their profit, and their margins, they just haven't recovered in tandem.
Oh,
Back in 2019, net income was $769 million. But in 2024, it was only $395 million.
ouch. Less than a half. So what does that really highlight?
It highlights a crucial point, the structural impact of higher costs. Labor, fuel, maintenance, these are pressing down on the entire airline industry.
So they're making more money overall, but keeping less of it.
Exactly. Not enough is flowing through to the bottom line despite that revenue growth. Now, this isn't unique to ALK, but it shows the pressure they're under.
How do they stack up against peers like Delta or Southwest?
It's kind of a mixed bag. ALK's net profit margin, around 2.86%, is honestly at the lower end of the industry. But interestingly, their return on equity at 15.01% is quite strong. That suggests efficient use of shareholder capital.
Okay, so better there.
Yeah, and that contrasts pretty sharply with Southwest, for instance, which has seen more significant struggles recently.
And what about liquidity? That current ratio below 1.0.
Right. Well, it's actually quite common for the industry. Airlines like ALK, Delta, Southwest, they typically manage their liquidity very effectively through strong operating cash flows rather than holding vast amounts of, easily convertible assets. It's just how the business tends to operate.
All right, so we've got Alaska Air. We see the industry challenges. Their financials are, as you said, a bit of a mixed bag. But what does this all boil down to for someone looking at the stock right now? It's fascinating how the market seems to be telling Alaska Air, okay, prove it first, right, before fully pricing in that ambitious Hawaiian Airlines deal.
Exactly, that show me stance.
And our deep dive really reveals why this translates into a pretty significant valuation gap. This nuanced valuation proposition is where things get really interesting, isn't it?
It absolutely is. Because, look, on one hand, you've got our discounted cash flow model, the DCF.
Right, projecting future cash flows.
Exactly. And that model projects an intrinsic value for ALK of about $68 per share, which on paper sounds pretty good. But what do you think that DCF really hinges on?
I mean, it has to be them actually pulling off that massive Hawaiian integration, right? Because that's the huge variable. That $68 feels aspirational.
Precisely. That $68 is the aspirational view. It assumes near-perfect execution. It assumes management successfully hits its long-term margin targets, especially that ambitious 11-13% adjusted pre-tax margin in their Alaska Accelerate plan.
Okay, so that's one view, the optimistic one.
Right. But the market isn't quite so optimistic. When we look at viewpoint 2, the cautious market value, we use relative valuation. We compare ALK to its peers. Delta, Southwest, American, United.
Using metrics like
If EBITDAR enterprise value to EBITDAR. It helps normalize for different financing and leasing structures across companies. And using that, the market median for their peers actually implies a valuation of only about $55 per share for ALK.
55 versus 68, that's a big gap.
It is. And when you synthesize these two viewpoints, you see that significant discrepancy. That $13 difference isn't just a number. It's the market's skeptical eyebrow raise, essentially.
The show me stance again.
Exactly. It tells us the market is pricing in those considerable execution risks we talked about, rather than just accepting the optimistic projections at face value. This synthesis, weighing both views, leads us to a fair value range for ALK stock of roughly $58.2 to $65 per share. It really crystallizes the market's current, more cautious perspective.
Okay, that makes sense. Now, given how brutal the competition is, intense rivalry, high buyer power, high supplier power, it makes you wonder, has Alaska Air managed to carve out any real competitive advantage?
Yeah.
An economic moat, as they say.
It's a great question because it is notoriously tough in this industry. But the report suggests ALK has indeed carved out what they call a narrow economic moat.
Okay, narrow, what's it based on?
It seems to stem from two main things. First, their brand loyalty and customer service. Alaska Air consistently ranks high in industry surveys for service, and that award-winning mileage plan loyalty program is a huge factor. It reinforces a really dedicated customer base.
People love their Alaska miles.
They do. And second, they have that strong niche market dominance we mentioned earlier in the Pacific Northwest and Alaska. That regional stronghold gives them a loyal following and, crucially, a degree of pricing power on those specific routes. Makes it harder for competitors to really chip away at their core business there.
So it's really about that regional dominance and customer loyalty. Sounds like a solid, if narrow, advantage in an otherwise cutthroat industry.
It is.
But even with that moat, there are some pretty substantial clouds on the horizon, aren't there?
Mm-hmm.
What are the major hazards Alaska Air might encounter on this path, especially with the Hawaiian deal?
Oh, absolutely. The most significant near-term risk highlighted in the report is, without a doubt, the Hawaiian Airlines integration risk.
Just the sheer complexity.
Immense complexity. Think about it. Merging two large airlines. You're talking about combining entirely different IT systems, aligning labor contracts across different unions with potentially different terms, blending distinct corporate cultures.
It sounds like a nightmare.
It can be. Any major missteps here could lead to massive service disruptions, which angers customers, and could mean a fundamental failure to achieve those projected synergies, the very synergies that underpin the whole investment case for the acquisition. It's a monumental undertaking.
And then layering on top of that integration challenge, we have operational and safety risks. The report explicitly mentions the January 2024 Flight 1282 incident, the door plug issue.
Right, the Boeing 737 MX-9 incident.
I remember seeing that all over the news. What was the real impact of something like that on a company like ALK,
Yeah.
beyond just the headlines?
Well, the impact is multifaceted and pretty profound. You had immediate fleet groundings, which costs money. You had costly repairs. You had significantly increased regulatory scrutiny from the FAA, which takes time and resources. And, of course, a definite hit to their brand reputation and customer trust.
That's huge for an airline.
It is, and crucially, this incident also diverted critical management attention and resources that were desperately needed for the Hawaiian integration. So it directly increases those already significant integration risks. It becomes this compounding problem where they're kind of fighting fires on two fronts at once.
Wow. Okay. And as if that weren't enough, there are other risks too, right?
Yes, several others to keep in mind. ALK stock has a highly sensitive beta coefficient 1.41.
Meaning it's more volatile than the market overall.
Exactly. So any big market swings up or down tend to be amplified for ALK stock. Then there's persistent fuel price volatility. Jet fuel is a huge chunk of their costs, maybe 28%, and sudden price spikes can severely erode profits very quickly.
Always a factor for airlines.
Yes. Always. Labor relations are another constant concern. There's always the risk of work stoppages or negotiating costly new contracts, which we've seen really plague other airlines recently. And finally, just the ongoing competitive pressure, especially in their key hubs from larger rivals like Delta, remains a constant threat, particularly on the West Coast. It's a never-ending battle for them.
Okay. So after this deep dive, putting it all together, what's the sort of complex investment case for ALK look like? On one hand, you definitely have a strong brand, loyal customers, a generally solid operational track record, and a truly compelling strategic plan, right? The Hawaiian acquisition, the Alaska Accelerate Initiative aiming for margin expansion, even the low PEG ratio, the price earnings to growth, that suggests potential upside if they pull it off. Maybe the stock is undervalued relative to its expected growth.
That's the optimistic side, yes. But
Yeah.
on the other hand, the path to actually realizing that potential is, as we've really highlighted, fraught with substantial risk. That Hawaiian Airlines integration is just a monumental task with a very high degree of difficulty. And this huge company-specific execution risk is layered right on top of the inherent cyclicality and intense competition of the airline industry itself. Not to mention an uncertain macroeconomic backdrop and the stock's higher than average beta. That's a very high stakes game they're playing.
So after synthesizing all of this, weighing the potential against those significant risks, our final recommendation for Alaska Air Group, ALK, is a hold due over a 12-month time horizon. Is that fair to say?
That's exactly right. The current valuation around that $58 to $65 range we discussed appears to reflect this equilibrium. It seems to be pricing in a degree of optimism for that bold strategic plan, but also, correctly, a healthy dose of skepticism about the execution.
So it's balanced right now.
It seems to be. Which means your strategy moving forward, if you're watching ALK, should be to monitor key indicators very closely.
Like what specifically?
Look for quarterly progress updates on the Hawaiian integration. Are they hitting milestones? Look for concrete evidence of cost control initiatives working. And watch for consistent margin improvement, quarter over quarter.
Got it.
Those will be the critical signs. If you start seeing positive momentum there, that's when you might see the risk-reward profile shift to a more favorable balance. And that's when you potentially reevaluate for a BUI rating. But
Okay, that makes sense. It's a wait-and-see, monitor closely situation.
So what does this all mean for you, our listener? As we wrap up this deep dive, maybe consider this. In a high-stakes, high-cost industry like airlines, that ability to truly execute on a bold strategic vision, that's what ultimately separates potential from realized profit. How much risk are you willing to take on a company's promise of future synergy, especially when the integration path looks this challenging? Something to think about. For the fastest and most frequent updates on market shifts and complex company analyses just like this one, make sure you subscribe to The Deep Dive. We're here to ensure you're always well informed. Thanks for joining us.